If you've been to the doctor much in your life, you've probably noticed that every time you go, whether you're healthy or sick, they run you through the same basic tests to start out. They check your temperature, check your blood pressure, your pulse, your breathing rate. They do this for every patient every time you visit. And you're probably also aware there's a good reason for them to run these tests. First, they want to make sure that you're not exhibiting any potentially dangerous symptoms that will turn into major medical problems, but they also need a baseline or starting point for your visit. Your vital signs will inform the rest of the treatment you receive, and not only that, if this is a physician that you visit regularly, vital signs provide data that can be compared over time to spot any trends that could be bad or good for your health. Well, similar to our physical health, there are several data points we can check from time to time to help us measure our own financial well-being and diagnose any potential issues. Today, we're going to cover 8 financial vital signs, starting with your emergency fund ratio. In case you're unaware, the very earliest posts on martinmoney.com included a central component to our website, the Next Dollar Roadmap. Now, the Next Dollar Roadmap outlines step-by-step a general path for anyone to follow to financial independence. The first milestone on that roadmap is the small emergency fund we call an uh-oh fund. Its purpose is to simply keep you above water in the event you face a sudden, unexpected expense like a car repair or a medical deductible. Just 2 milestones later, though, after employer matching and debt elimination, is a larger, fully funded emergency fund. We cleverly named it the Fully Funded Emergency Fund. Both the uh-oh fund and the fully funded emergency fund are like life preservers in a boat. You probably don't think much of them until you need one, but when you do, they are invaluable. In a financial sense, emergency funds allow us to absorb sudden shocks or setbacks without knocking us off track completely. I and many others recommend keeping at least 3 to 6 months of expenses in this emergency fund so you can ride out a period of reduced income or heavier than expected expenses. Naturally, to calculate the sufficiency of your emergency fund, you'll need to know how much you normally spend each month, because this will determine how quickly you burn through your reserve cash. In the formula we provided, simply divide your available liquid cash by your average monthly expenses. So for example, if you have $15,000 in cash and your monthly expenses are $5,000 per month, then your emergency fund ratio is 3. Anything higher than this is good. Anything lower, and you should consider stocking up a bit more in cash. Now, to clarify, when I say cash, I mean anything that could be liquidated quickly with little to no concern over its value at that moment. So think savings accounts, money market accounts, or money market funds, CDs. Those are all examples of cash equivalents. Houses, stocks, treasuries, those all take time to liquidate, or they could be less valuable when you sold them if you had to liquidate them in an emergency, so they aren't great options for an emergency fund. Think of it this way: just like you wouldn't put a fire extinguisher in a difficult to reach place, your emergency fund cash needs to be accessible. Also, if you're in a situation where you and your loved ones are depending on a single income, or your income sees large fluctuations in reliability, you should consider increasing this ratio to 6 at a minimum and consider saving all the way up to a full year of cash. Having unreliable or concentrated income calls for a higher margin of safety. The second vital sign is the housing and transportation ratio, or the HAT ratio. On average, Americans spend a combined 45% of their income on housing and transportation, just 2 items. Now, the good news is, on average, this leaves enough money each month for us to mostly cover expenses like food, utilities, clothes. The bad news is this doesn't leave enough money available for building adequate retirement savings. If you want to work forever, this isn't a problem, but if you'd like to retire one day, you need to make some difficult choices to do so. In my opinion, one of the easiest ways to leave room for saving and investing a healthy portion of your income is to limit your expenses for housing and transportation as much as possible. For one thing, we're likely to find success if we only have to extract it from 1 or 2 sources as opposed to all the other things in our budget, but it's also much easier to hold our costs in these 2 categories steady if we make wise purchasing decisions. So for example, housing costs won't change at all if you have a fixed rate mortgage, and they probably only change annually if you're a renter. Car payments are also normally secure as well, and that's especially true if you don't have any car debt at all, obviously. So just like it's very easy to overextend ourselves on these 2 items, it can also be very easy to get our budget in line by using these 2 items wisely. I recommend spending no more than 30% of your income on your cumulative costs for housing and transportation together. To calculate your HAT ratio, simply divide your combined monthly housing and transportation costs by your monthly take-home income. So if your monthly income is $7,000 and your housing and transportation costs are $2,000, your HAT ratio is 28.6%. Now, I know there are many who scoff at the idea of having a HAT ratio below 30% because housing is so expensive where you live. At first, I'd point out that this is a combined housing and transportation ratio. If you want more house, then buy less car. And I'm also not completely against going a little over the mark here if you're buying a first home and you expect your income to increase with time. If you're close to that 30%, the HAT ratio should eventually slip down into a healthy range. Now, as far as transportation is concerned, I'm in no way endorsing car debt. If you don't have a car loan, please don't interpret this as permission to go get one just because your mortgage is below 30%. In my opinion, car debt is one of the single most destructive forces to personal finance that there is. If at all possible, and I personally think it should be for nearly anyone, try to pay cash for your car. Vital sign 3 is your consumer debt ratio. Do you want to know a not so closely guarded secret about most millionaires? They don't have consumer debt. Now you might point out that they have enough cash so they don't have to take on debt. And you're right, but you want to know another not so guarded secret about most millionaires? They didn't have consumer debt before they were millionaires either. The truth is, avoiding consumer debt is a key step toward building wealth. Just like you wouldn't try to sail around the world with your anchor dragging the ocean floor, it's difficult to imagine how anyone could expect to become wealthier while paying high interest to lenders. There's really not much to add here, just say no to debt. Now, to calculate your consumer debt ratio, simply add all of your debts and divide them by your monthly income, or any income that you have for that matter. So for example, if you have $12,000 in debt and a monthly income of $7,000, your debt ratio is 1.71, which is much higher than 0. Now, to be clear, I don't consider mortgages or student loans as consumer debt, but that doesn't mean you shouldn't pay them off. I consider consumer debt to be a debt that's issued against a depreciating asset, so think appliances, cars, or nearly anything that you would buy with a credit card. You're much better off just avoiding debt for these things altogether. Vital sign number 4 is your saving and investing ratio. Now, I've already touched on the importance of saving and investing at least some portion of your income, and now I'll explain why. Simply put, your money needs time to grow. You can't afford to wait to make investing a priority. So for example, here are the differences in value of an investment portfolio that receives a $100 contribution each month for 50 years with a 10% annual rate of return. As you can see, the effects of compounding interest are incredible. If you go back to the sailing metaphor I used earlier, compounding interest acts as an incredible tailwind that can absolutely make you wealthy, but it takes time to work. Just look at the way the balance grows with a $100 contribution each month, much faster than the years as time goes on. While I was recording this, I decided to make a chart, so I'll stick it in here now, that shows just how the trajectory over time, even though you got 10-year increments, the balance of this savings kind of exponentially grows, or has sort of I almost call it a hockey stick effect, but there's a vertical line and it's growing faster as time goes on. So even though the balance at 10 years and even 20 years doesn't look that impressive, over the decades, when you reach 40, 50 years, that's quite a large sum of money. Now, if you're just getting started on saving and investing and you're in your 20s, I generally recommend that you save around 15% of your income. If you're starting in your 30s, go with 20%. If you're in your 40s, start with 25% after that. If you're just getting started in your 50s and 60s, you need to save as much as you can. Now, to calculate your savings ratio, simply divide the amount you save and invest each month by your monthly income. So if your income is $7,000 a month and you normally save $800 a month, then your saving and investing ratio is 11.4%. 11.4% is lower than 15, 20, and 25, so you should consider taking it up a notch unless you're a teenager. Now, for more about how much to save and invest each month, we actually shot a video that explains the percentage of your income that you should save each month based on how far you are from retirement. I'll put a link to it above. So if you find the financial vital signs helpful at all, would you please consider clicking like and subscribe below? That really helps our channel a lot. It actually allows me to continue making videos so I can help teach people about personal finance. Vital sign number 5 is your ROI, or your return on investment ratio. One of the greatest challenges in selecting investments is there's no way to know how they will perform in the future. This is also why I don't bother trying. For me, there's little reason to do more than invest in a cost-efficient, diversified basket of stocks through low-cost index funds. Now, in case you're unfamiliar with index funds, allow me to provide a quick explanation. For many years, mutual funds were only managed by human fund managers who made investment decisions for the fund according to the fund prospectus for the benefit of the fund and its investors. Their goal as fund managers is always to generate the greatest amount of return possible for the fund according to its stated objectives. Then in 1975, John Bogle introduced the first index investment trust, which more or less tracked the S&P 500 market index. The primary benefit of index funds is they don't require hands-on management from a human, which can also be quite expensive and erode the fund's profitability. Now, even though he wasn't technically the inventor of the index fund, John Bogle is largely responsible for making them what they are today. Now that they've built some history, studies have shown that index funds outperform their actively managed peers around 80% or more of the time. In other words, by following an index, the management costs of the fund are reduced such that the end return for investors is higher than that of their peers. This may be one of the more challenging ratios to calculate depending on what investments you're comparing. Personally, I would suggest researching the prospectus or the holdings of a mutual fund that you're interested in and search for an index fund that follows a similar strategy. Next, I'd find each fund's stated returns and compare them for the same time period by dividing the performance of the fund you own by that of a similar index fund. You'll also want to be sure that the stated return also includes expenses associated with the fund so you have a true apples-to-apples comparison. If the fund you own produces a higher return than your selected index competitor, you're good to go. On the other hand, if the index produces a superior return, you should probably make a switch. So as an example, I compared Fidelity's actively managed large cap equity fund, that's IICAX, with Vanguard's large cap index fund, VLCAX, using their 2023 returns. IICAX returned 21.7%, while VLCAX returned 27.28%. Now, frankly, I was expecting the index fund to win easily, but not that easily. Anyhow, the ratio for this comparison is 0.795, which is quite a bit below our goal of 1. I would sell IICAX in favor of a less expensive investment. Speaking of less expensive, IICAX's expense ratio is 1.79% compared to 0.05% for VLCAX. There's actually a post on our website that illustrates how just 0.9 of a difference in the expense ratios in a portfolio could have hundreds of thousands of dollars of impact over the course of a few decades. A gap like 1.74% is enormous. Don't overpay for your investments and be sure their returns track with their peers and benchmarks. Vital sign number 6 is your concentration ratio. I want to start this one off with a humbling story. First it's awesome, then it's pretty humiliating. In 2017, I bought Roku stock for around $40 a share. And in 2021, as we were in the throes of the pandemic and people were at home streaming a lot of TV, the stock almost reached $500 per share. My holdings were well into a six-figure value at that time. Now, for some reason, I had selected $500 as my get-out price and decided to stay put until the stock hit that mark. Unfortunately, the price retreated in mid-2021, but rebounded later in the year. I was confident that it would surpass $500 eventually, but it didn't. It just fell and fell and fell. I vividly remember selling it after it dropped below $200 a share, and I actually held on to some of it even then. Now that's still a five-fold increase, but all I could see was a stock that was less than half as valuable as it once had been. Again, it was worth over six figures at one point, so this was a huge cost. The problem with owning individual stocks is that we tend to set artificial buy and sell points that we don't stick to or never reach. What we should do is set a rebalancing policy that we hold ourselves accountable to no matter what. Now, rebalancing is a very wise way to invest because when times are good, it forces us to take gains off the table before we lose them. And conversely, when times are bad, rebalancing forces us to buy while prices are discounted, ensuring that we participate in better future returns. Most commonly, people rebalance asset allocations from stocks to bonds and vice versa. When stocks are doing great, we sell them in favor of bonds, which could be lagging or they could be available at a discount. On the other hand, when stocks are taking a beating, having a rebalancing strategy forces us to do the scary thing and buy when prices are low, making our future returns even more valuable. And you should also do this with individual assets that make up a large portion of your portfolio. Personally, I don't recommend that you own individual stocks, but if you do, make sure that no more than 10% of your total investment portfolio value is in a single investment asset. Now, most often this is going to be a single company stock, but if you invest in real estate, for example, it could be a single or group of very similar properties also. Now, to calculate your concentration ratio, simply divide the value of the single investment asset you own the most of by your total investment portfolio value. So, for example, if you have $30,000 of Tesla stock and a $150,000 portfolio, you have a concentration ratio of 20%. That means I would sell at least half of that to get you down to that 10% level. Now, you should especially keep an eye on this ratio if you're given or sold stock at a discount by the company you work for. In this case, your income and your investment assets are connected to one single company. That's a lot of eggs in one basket. Consider selling those company stocks or at least limiting the amount you accumulate. Also, you can leave your personal residence out of this ratio. It's a use asset, not an investment. Vital sign number 7 is income diversity ratio. Now, just like diversification in asset classes provides stability in investing, having multiple sources of income provides stability to your cash flow. I have shared in previous videos that I was unemployed for a brief period in 2015. Unemployment helped me to realize a few things. First, it opened my eyes to how little control I really have over my own employment, which is another way of saying that it really helped me see that as long as my income was coming from my job, I was totally dependent on that job. Being dependent on something I couldn't control did not sit well with me. Now, one of the ways to limit this dependency is to generate multiple income streams, and that is much easier said than done. I'm not sure about you, but one 40-hour per week job is about all that I have energy for. The good news is we live in a time and an economy that is far more friendly to side hustles than ever before. I won't enter a lengthy discourse about other potential sources of income, but I will challenge you to keep an open mind and think about how your talents might align with a market of some sort. Odds are there's something for you out there that you can get paid to do in your free time. Additionally, as we get into this ratio, you're going to see that single folks have a bit of an automatic headcount disadvantage in your household that makes income diversification all the more challenging. I'm not suggesting that you enter a relationship for the sake of improving your income diversification ratio, but you could at least have a healthy understanding of the extent of your dependence upon any one source of income by calculating it. So even if changing this ratio would be a significant challenge for you, just going through the motions of calculating it is helpful for developing some perspective. So to calculate your income diversity ratio, simply divide your largest household income source by your total household income. So for example, if the largest source of income in your household is $75,000 per year, but your household income is $135,000, your income diversity ratio is 55.5%. Our final financial vital sign is your investment efficiency ratio. Your investment efficiency ratio is the percentage of your savings that is directed into a tax-advantaged account like a 401k, IRA, or HSA, relative to the total amount you can contribute to these accounts. Now, the purpose of this is to highlight how tax efficient your investment strategy is. Money saved in these accounts receives tax benefits that are otherwise unavailable. So each dollar saved elsewhere is actually costing you money. Now, to calculate this ratio, simply divide the amount you contribute to tax-advantaged accounts each year by the total amount you can legally contribute to tax-advantaged accounts. So for example, if you contribute a combined $10,000 annually to both an IRA and 401k, but you're eligible to contribute up to $7,000 to the IRA and another $23,000 to the 401k, your investment efficiency ratio is 33.3% because $10,000 is 33.3% of $30,000, which is the eligible space you have to contribute to tax-advantaged retirement accounts. Now, a good target for this ratio is really dependent on your income, but you should be able to contribute at least 15 to 25% of your income into some combination of these accounts each year. Anything below that should be addressed. So I hope you found these financial vital signs helpful. As always, there's more on our website at markmoney.com. We have lots of other playlists to help with topics related to these. As always, we are grateful for your interest and your time. God bless and take care.